We're jumping straight into Applied Digital today.
Let's do it.
If you've been watching the market, you've seen the volatility. This stock surged, what, 17% just ahead of Q2 earnings?
Yeah, and that's on top of just a massive run year to date, over 200%.
Exactly. And everyone is watching that price action, the day-to-day. But the real story here, the fundamental thing driving this company, is that huge, nearly $16 billion contracted backlog.
That's the number, 16 billion.
And their aggressive move into next-gen AI data centers. We're not talking about some pivot from crypto mining anymore. This is a dedicated AI infrastructure play, and that backlog, that's the core catalyst.
You've hit the nail on the head. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Yeah, it's great to have you.
This company is trying to position itself not just as another tech company, but as a crucial piece of infrastructure, almost like an AI landlord,
An AI landlord, I like that.
They're focused squarely on this just insatiable demand for high-density GPU computing.
If you're finding this analysis valuable, definitely make sure to subscribe and hit that like button. It really helps us reach more people.
It really does.
And let us know in the comments which stock you want us to break down next. Okay, so let's unpack this, the bull case versus the immediate risks.
All right. So the investment case for Applied Digital, it really rests entirely on their future capacity and, more importantly, their execution.
Right.
We need to look at the numbers to really get the scale of what they're trying to do.
Yeah.
On the bull side, the demand is it's almost overwhelming.
Okay.
So while their cloud services business reported, trailing 12-month revenue of about $75 million as of August 2025, that number is, frankly, it's completely overshadowed by the projections.
And this is where the story shifts from, normal growth to something exponential.
Precisely. Analysts are projecting fiscal 2026 revenue to land somewhere between, say, 280 and 297 million.
Okay, so that's already a huge jump.
It is. That's robust growth. We're talking 30 to 38% year over year. But the real inflection point, the big one, is fiscal 2027.
That's the magic year. That's when all this new capacity comes online, right?
It is. In fiscal 2027, the revenue projection just skyrockets. We're talking $541 to $553 million.
Wow.
That jump, an 86 to 93% growth in a single year, that is the clearest signal the market has that this AI infrastructure crunch is, well, it's real and it's urgent. It basically confirms the capacity the ruling has already sold.
And that brings us right back to the number that underpins everything. That $16 billion backlog. For anyone listening, what does that number, what does $16 billion in contracts actually mean in practice?
It's the ultimate de-risking mechanism. It really is.
So it's not just a wish list.
No, not at all. This isn't a speculative pipeline. This represents multi-year, non-cancelable leases, primarily signed with investment-grade hyperscalers.
And when we say hyperscalers, we mean the biggest names in the game.
The absolute biggest. The companies driving AI development globally. They're locking in this specialized capacity years in advance because, frankly, they're desperate for it. And the contractual security gives Applied Digital immense long-term revenue visibility.
Which is how they get over the near-term losses. Because we know they're expecting an EPS loss this year, right? Around -31 cents, because they're just in maximum build-out mode.
That's exactly right. You have to frame the current cash burn, the negative free cash flow, as a strategic investment.
Right, capital expenditure.
It's all CapEx. They are massively investing to construct that 4-gigawatt pipeline. Yeah, it's painful in the short term, but it's absolutely necessary to unlock that 2027 profit explosion.
So financially, when does that pivot happen? When do they flip to positive?
Fiscal 2027. Projections are anticipating a transition to a positive EPS of about 15 cents, and this is the crucial part, positive free cash flow.
That's the key.
That's when those huge new facilities are fully operational and the high-margin recurring revenue from those long-term leases really starts to kick in.
Okay, that leads right into the next big question. If the growth story is so clear, what makes Applied Digital stand out? You've got massive incumbents like Equinix, other players with deep pockets. Why would a hyperscaler pick them?
Their competitive edge, their moat, it's all rooted in physics and specialization. What's so fascinating is their laser focus on extreme efficiency for AI workloads. And that starts with their proprietary direct-to-chip liquid cooling technology.
Direct-to-chip liquid cooling. Okay, that sounds pretty complex. Let's break that down. Why is that so essential for AI, and what makes their version special?
Well, think of it like this. Training a huge AI model, It requires thousands of powerful GPUs running all at once. It generates an insane amount of heat. It's like running 1,000 ovens in a closet.
Right.
Traditional air conditioning just can't handle it. The servers overheat, they slow down, and that costs the hyperscaler a ton of time and money.
So you have to cool the chips direct.
Exactly. Direct-to-chip cooling lets them manage that crazy heat load, and this enables what the industry calls high rack density. Their tech allows for densities over 100 kilowatts per rack.
Wow. What does that mean in simple terms?
It means they can fit the computing power that used to need a whole football field of servers into, like, a single room. It is just a sheer consolidation of power.
And I've got to imagine that efficiency shows up on the power bill.
Oh, absolutely. They claim their cooling solution is 3,000 times more efficient than traditional air cooling, specifically for these AI training jobs. And that's measured by a key metric called PUE.
Power usage effectiveness. I hear that all the time. Help us understand what their number, 1.18, what that actually means.
So a perfect PUE is 1 point never.
Right.
That means every single watt of electricity goes to the computers, with zero waste on cooling or anything else.
Which is impossible, basically.
Right. It's a theoretical ideal. The industry average is often closer to 1.6 or 1.7. Their reported PUE of 1.18 is near the best in class. It translates directly to lower operating costs for their clients and, importantly, minimal water use.
So they've got better tech, but they also have speed.
That's the second part of the moat. The hyperscalers need this capacity now, not in 3 years. Applied Digital's timeline is about 12 to 14 months for one of their Polaris Forge AI factories.
Much faster than the industry standard.
Way faster. They're agile, they're specialized, and they have that 4 gigawatt pipeline already in development with secured, low-cost power in places like North Dakota.
And securing the power is half the battle, isn't it?
It's the ultimate barrier to entry. Getting 4 gigawatts of cheap, reliable power is a massive competitive advantage.
Okay, that covers the fundamentals. Let's pivot to market sentiment and the immediate stuff. The stock's been volatile, but we've seen these buying phases.
Yeah, it's been a roller coaster for sure. A lot of that is driven by high short interest. But we have seen these clear accumulation phases tied directly to milestones, like that huge $5 billion hyperscaler lease they announced. That caused some heavy buying.
And we can't talk about unlocking value here without mentioning the Chronoscale spinoff. That seems like a really critical piece of the puzzle.
It is. It's really a mechanism to clean up the corporate structure. The plan is a spin-off and merger, but Applied Digital keeps a massive 97% ownership stake.
So what's the point?
It lets the market put a separate, clear valuation on the core AI data center business, the $16 billion backlog part from the existing cloud services platform that Chronoscale represents. It's a way to show investors two distinct, valuable assets.
And this is all happening while the big players are planning to spend, what, almost $500 billion?
That's the crucial context. The hyperscalers have CapEx budgets between $380 and $500 billion. They can't build it all themselves fast enough. Applied Digital is positioned perfectly to capture that overflow.
Okay, this sounds incredibly bullish. But we have to provide some balance. If the story is this clear, why isn't the stock even higher? What are the immediate risks?
The primary risk, and look, it's a big one, is execution risk.
Just getting it all built.
Exactly. Going from $75 million in revenue to over $500 million in 18 months while building out a 4 gigawatt portfolio. I mean, think of the complexity, supply chains, permits, labor. Any significant delay could derail that whole 2027 pivot.
And financially, they're still burning cash until then.
Absolutely. They are reliant on the capital markets until that 2027 inflection point. If financing tightens or they hit a snag and need more cash, that negative free cash flow leaves them exposed.
Let's talk about the valuation. I mean, the stock trades at a huge premium right now.
It does. It's around 19 times forward price to sales. The sector average is closer to 9. So that 19 times multiple tells you the market is pricing in near perfect execution.
No room for error.
None. Any stumble, any miss, any guidance cut, and that multiple is going to contract fast. And that will cause some major short-term pain.
And we also have to talk about the risk that's tied directly to that huge backlog number, customer concentration.
That's a key vulnerability. The contracts are secure, yes. But that $16 billion relies heavily on just a few major hyperscalers. If one of those anchor tenants ran into issues, it could severely impact revenue visibility.
So it's a few very big eggs in one basket.
Very large, very lucrative basket, but yes.
All right, so let's drill down on the most immediate catalyst. Today's Q2 earnings report after the bell.
Right. So consensus is looking for about $82 million in revenue and a loss of 22 cents per share. But honestly, the market's going to look right past that loss.
What are they looking for?
guidance. They need clear, tangible updates on the backlog. Are they hitting their construction milestones for the Polaris Forge facilities? And second, they want an update on the Chronoscale merger. Is that still on track for the first half of 2026? Those updates are way more important than this quarter's numbers.
So what does this all mean for you, the listener? The core story for Applied Digital is really compelling. They're an agile AI infrastructure provider with a strong tech moat. That $16 billion backlog de-risks their future. But you have to monitor that execution risk and listen closely to what management says today. Perfection is priced in.
I think the biggest question for you to think about is this. What does that acceleration from, say, 30% growth in fiscal 26 to over 85% in fiscal 27 really tell us about the urgency of the AI infrastructure crunch? I mean, this company is planning to more than double revenue in 1 year. Now consider if these rumors about negotiations for 2 new 4-gigawatt sites materialize. It suggests the demand is so far outpacing supply that the need for a company like Applied Digital is becoming critical.
That's the breakdown on Applied Digital for today. If you haven't already, subscribe so you don't miss our next analysis. We'll catch you on the next one.